Hello and welcome to the THORChain economics paper walkthrough on Rebase. Today we're going to go through the economics paper in a slightly different way to how we went through the white paper, and we're going to actually have the economics paper on the screen so that you can see, as I'm walking through it, what specifically we're talking about. And I think that should help aid understanding a little bit. If you've got any questions, you can reach out to us on the site. There's a live chat feature, or you can find the email there, or you can just reach out on Twitter. Anyway, I hope you find this useful. Let's dive right in. So THORChain is a decentralized network which makes it possible for people to swap digital assets in a permissionless way. These digital assets include Bitcoin, Ether, and Binance Coin, and many more in the future, which all live on different blockchains. These assets will be swapped in a permissionless way, meaning that there's no central company or organization saying which assets can and cannot be swapped. THORChain aims to do this using only assets provided to it for swapping, like Bitcoins. That's the first thing. The second thing is price information from connected networks, again like the Bitcoin network, and rewards by giving out Rune, which is THORChain's own native asset, to people taking part. Continuous liquidity pools, as you can see here, are central to the THORChain network. They tie the price of external assets, that is, assets which are from networks other than THORChain, in a deterministic way. So deterministic really means that when you swap an asset, what you get is set by a formula, and it makes the output perfectly predictable. This tying of external assets to the native asset means that the value of external assets is linked directly to the value of Rune. So as the value of external assets goes up, so does the value of Rune. A unique feature of CLPs, or continuous liquidity pools, is that they provide price feeds which can't be manipulated. This means that THORChain doesn't need to rely on prices from outside the network, which is great because external price feeds have been a problem for a lot of other DeFi projects. Rune is used as what's called a settlement asset, and this means that whenever you swap an asset on THORChain, it passes through Rune. For example, if you're swapping from BTC to ETH, the passes through Rune. Rune is also used as a security deposit for nodes. Okay, so moving down from the abstract to the introduction, let's go through that. So to stay safe, what we're talking about here is that to stay safe, the cost of attacking a network like THORChain needs to be higher than the value of capital it is taking care of. So if you can attack the network for less than you gain, so for example, if you can spend $100 to attack the network and you can make $105, then the network is not safe. There are three main models. So as we move on to the next part, which is discussed, is the three different types of models which the THORChain team considered for the basis of the network. One is proof of authority, the next is proof of work, and the final one is proof of stake. So starting with proof of authority, an example of proof of authority is the likes of Blockstream. Problem with Blockstream and proof of authority networks are that they have uncertain security models. They're based on trusting a central body. So if something went wrong with Blockstream itself would lose its reputation and the people in it would lose its reputation, but this is intangible and it's really not a reliable source of protection. Another alternative is proof of work. So proof of work wouldn't work for THORChain because it's really too difficult to tie the value of securing external assets with that of securing the network. The proof of work, by the way, for example, obviously is Bitcoin uses proof of work. So this problem of tying the value of securing external assets to that of securing the network is really because the cost of securing the network is measured in offline, less tangible assets like mining equipment and electricity. And what's more, a proof of work network would be just much less efficient. So again, proof of work is not desirable for THORChain. And so THORChain has settled on proof of stake. In proof of stake, the costs to attack the network are based on how much raw financial capital it would take rather than on how much reputation would be lost or how much computing power could be mustered. The network is pushed in the right direction by rewarding and punishing different actions in the people taking part. So for THORChain to make sure its assets are safe, it needs three things, which are listed here. Three critical things. The first is that it needs to know the value of its external assets. For example, external assets being Bitcoin, Ether, Binance Coin, etc., etc. It also needs to know the value of its native asset, which is called Rune. And the third thing it needs is a reliable way to make sure people act to keep the system secure. So these first two, THORChain achieves using continuous liquidity pools, which we'll go into in more detail. And the third one is achieved using something called the incentive pendulum, which is a reward system and keeps the balance of assets correct at what's known as the optimal capital distribution. The next piece is assumptions, and there are really three main assumptions that the THORChain system has, which are important to its success. The first one is that less than 1/3 of actors taking part are working to take down the network for non-financial reasons. The second is that less than 2/3 of actors taking part are working together to steal assets. And the third is that Rune is worthless if the network is attacked and assets are stolen. So this first part here is assumption 1, which relates to irrational actors. So THORChain assumes that there may be actors on the network who want to take it down. These actors don't want to take it down to make money, but for other reasons. They'll spend money to take the network down even if they lose that money. And so for an example of this type of actor is a national level government. The network can be stopped in two situations. Firstly, if blocks are not being added to the blockchain, and secondly, if assets are stopped from being sent out of the network by affecting threshold signature scheme signing sessions, i.e. when nodes operate together to approve sending out assets from the system. The latter, if that process of sending assets out of the system stops, that means that the network's swapping service is offline. So it's basically there's no service being provided. The network is no longer providing its service, and also that nodes can't get their bonds and rewards back, which means that they're not going to want to be a part of the system anymore. The second assumption is described in this paragraph, and it's about colluding actors. So THORChain also assumes that there are actors who are trying to steal assets from the network, i.e. that there are actors who are trying to profit by attacking the network. These actors need to communicate with one another, so they're working together and colluding to attack the network, and they become nodes and work together in order to send assets out of the system to themselves. The last paragraph here of the third section is the third assumption, which is about Rune value. So THORChain assumes that Rune has value because of the role it plays on the network. Rune enables people to swap assets. If those assets are stolen, then Rune can no longer be traded for those external assets, and the colluding actors cannot sell their bonded Rune. If Rune is stolen, it immediately loses its value, and that's a big part of that third assumption as well. Okay, so the next thing to cover, the next section, is definitions. Now, Rebase will be coming out with a full list of definitions later on, where we go through and understand the exact terms which you need to know in order to fully understand the THORChain network. But for now, let's focus on these. So the first one we've got is the network native asset, and this just means Rune. The second one is bonded capital, which means the total amount of Rune which nodes have locked in the system. Nodes need to lock up Rune in order to take part. Pooled capital is the total value of assets which have been placed in liquidity pools. So this includes both Rune and external assets. Pooled native assets is the amount of Rune in pooled capital. So it's basically the amount of Rune minus all of the amount of pooled Rune minus all of the pooled external assets. And then pooled external assets are the amount of pooled capital minus the native assets. That's i.e. the pooled assets minus Rune. Okay, so the next section is about optimal capital distribution. So the optimal capital distribution, i.e. the balance of capital between bonded capital and pooled capital, bonded being where nodes are putting up Rune in order to take part in the network, pooled capital being a mix of Rune and external assets, which is provided by liquidity providers. So the optimal balance of those, or the optimal capital distribution, is when the value of bonded capital is equal to or higher than the pooled capital. We'll see this in the diagram in a second. So if the value of bonded capital falls below the value of pooled capital, the system is unsafe. It's unsafe because at this point, nodes can steal more value than they've bonded, i.e. it's profitable to steal. So if we take a look at this visually, you can see here that let's look at unsafe first. So you can see here that the amount of bonded capital here is less than the total amount of pooled capital. In actual fact, here the amount of bonded capital is equal to the amount of Rune in pools. And this is unsafe because it means that it's profitable to steal, because you can put up as a set of colluding nodes, you can put up a certain amount of capital in terms of Rune, and then you can steal from the pooled capital and make a profit. Here at the top you have the safe situation, which is where bonded capital as a total is higher or, well, equal in this case, ideally equal to the amount of pooled capital. So below here, and this actually took me a fair bit of time to get through to fully grok. These are notes on the calculation, which helps you understand it a little bit better. So only 67% of nodes need to work together to steal all the assets. Given this, the system is safe up until 60% of Rune is bonded and 40% is pooled. That's what this first part talks about. In reality, the situation is helped by the fact that secondary vaults only contain 50% of assets. See that there? So if 67% of nodes are attackers, they only ever have access to 5/6 of the total assets. And this brings the point of safety back down to a more efficient 50% of Rune being bonded. Having said all this, we're on this paragraph now. If the secondary market somehow adds additional value to Rune, I'm not sure what the exact scenario there might be, if it's a monetary premium type of situation, or I actually need to clarify that. But this could increase the required safety threshold again, because it would put the system out of balance. THORChain team estimates that up to 10% could be added to the value of Rune in the secondary market. And so in order to protect against this and to provide a buffer, the system increases the safety threshold on top of the 50%, which we described here, to require 67% of Rune bonded and 33% pooled. So let's talk about system income and how it's distributed. System income is, in essence, all of the income that the network generates, and it's calculated by adding liquidity fees from swaps happening on the network and block rewards. So what we can see here is that the network targets having node income and liquidity income equal. You can also see that this, when allocating system income, the system takes into account the cost of running a node and the cost of providing liquidity, which we'll talk about in a second. The incentive pendulum is also worth taking a look at in this context, and we'll talk about that more later because that's what keeps the balance in check. So this is a good visualization of what the system might look like if the cost of running a node and the cost of providing liquidity were equal, but in reality they're not. And that's what the rest of this section is about. So firstly, to talk about the impact of cost on nodes. Nodes obviously have to spend money to run the network software. And the team estimates it to cost about $1,000 per month. In addition to that, nodes also need to have technical expertise to run the network software. The graph below, this graph, shows the potential margins over 36 months post-launch for nodes based on a few assumptions. And you can see ultimately that the cost will be, after 36 months, will be about 30%. So the assumptions that this is based on are that the network goes from 12 to 99 nodes in that period, that the monthly price of the Rune price increases by 5% per month, and that the cost of running a node increases by 2% per month on that initial 1,000. So that's some idea of the cost to nodes. Then we get to the cost of liquidity providers, which is quite different. It's quite a different structure to that of nodes, because liquidity providers really have very little real world costs, but they do bear a cost in terms of what's called impermanent loss. We'll do a more detailed dive on impermanent loss. There's been quite a lot of coverage from other automatic market makers, which can be looked into. But basically, this is impermanent loss happens because of the exchange formula, and it means that over time, depending on the price that you deposit your assets into a pool and the price when you remove them, you may suffer a small loss in your assets. So with THORChain, impermanent loss is estimated to be about 10% per year, or a little less than 1% per month. And this is based on a few assumptions. So that's based on the assumption that the price of Rune will increase by 10% per month, that liquidity providers will, this assumption is based on liquidity providers having a 12-month entry and exit, i.e. putting their assets in and only taking them out after 12 months, and that the Rune, and so after this, we would expect the cumulative gain in the Rune asset to be 150% and a 10% impermanent loss. So that's how that 10% impermanent loss is calculated. what I would note, and is maybe I'm misinterpreting it, but it looks like the assumption for, and I think these are just illustrative examples, but to illustrate the impact of cost on the distribution of system income. But the assumption around Rune asset increase, monthly increase in prices is different between liquidity providers and nodes. So for the liquidity providers, it's 10% here and 5% for nodes. But as I say, that's I think this is all just illustrative anyway. So this diagram shows what is more likely to be the distribution of system income. So notice that node income and liquidity income are still the same, even though the cost of running a node and the cost of providing liquidity are different. And so that's been achieved by adjusting the initial target split of system income to it says 65% and 35% here, but it says 67% and ultimately says 67% and 33%. And I think that is actually correct, and I think this is more illustrative. So ultimately, the node rewards will need to be higher than liquidity rewards because of this differential in cost, and the system will target 67% of system income to go to node rewards and 33% to go to liquidity rewards. Let's talk a little bit about the incentive pendulum, which is a critical component of the system because it helps maintain the optimal capital distribution, which we described earlier. Let's go back up just to refresh the memory. This was optimal capital distribution, and this is the optimal capital distribution here, where the amount of bonded capital equals the total amount of pooled capital. So obviously the system is dynamic, and this balance is not set in stone. This can change. And if it does change, then the capital distribution is no longer optimal. It can either be unsafe or it can be inefficient. So in the case where it's unsafe, the bonded capital is much higher. The bonded capital is actually lower than the total amount of pooled capital. And we don't have a diagram of it yet. It will follow, but in the case where the system is inefficient, the bonded capital is much higher than the pooled capital. So you could imagine these circles being much smaller. And that means that the system is inefficient because the bonded capital, the amount of value which is being used to secure the network is much higher than the actual assets which are being secured, which obviously doesn't make sense. So the incentive pendulum changes this split here, the amount of liquidity rewards and the amount of node rewards which are being given to nodes and to liquidity providers, in order to rebalance the situation. So let's walk through the two situations we described earlier, which are the unsafe and the inefficient. So what happens what does the incentive pendulum do when the system is unsafe? Well, because bonded capital is less than total pooled capital, the first thing the incentive pendulum does is to increase the bond rewards or the node rewards. So in doing so, that will increase the incentive for nodes to bond and to bond more Rune. Simultaneously, the incentive pendulum will reduce liquidity rewards, meaning that fewer people will want to provide liquidity because they're not getting the sweet rewards which they were earlier. So this will naturally mean that bonds, as I say, nodes bond more Rune, people provide less liquidity, so these circles will shrink back to the safe, towards the safe levels, and bonded capital should increase. So that's what happens when bonded capital is lower than pooled capital and the capital distribution is unsafe. The second situation is when bonded capital is much higher than pooled capital, when the capital distribution is inefficient. So in that situation, the bonded capital would be much, much higher than pooled capital. So these circles would be much smaller. And in order to fix the problem, the incentive pendulum would do the opposite of fixing the unsafe situation. So what it would do would be to lower bonding rewards such that fewer nodes bond and bond less room, and it would raise liquidity rewards so more people provide liquidity. And the effect that would have would be to decrease the relative size of this circle and increase the relative size of this of these two circles, bringing it again towards the safe zone. And again, just to illustrate that the incentive pendulum operates here by changing the amount of node rewards, which are the amount of node rewards and the amount of liquidity rewards which are being paid out. This is a formula to describe that, and we'll cover that again. We'll create something to explore that on Rebase as time goes on. This table is pretty useful for looking at the different scenarios. So I was talking about the inefficient sort of extreme one here, and the unsafe one. So if we walk through the inefficient, what we have is bonded assets at 100%. So 100% of room is being bonded by nodes in the situation, and 0% of room is being staked. And that essentially means that there's a load of value going into securing the network and basically no value in the network, which is massively inefficient. It's just a waste of money. Unsafe is when the bonded assets, i.e. the amount of room, is equal to the amount of staked room. And therefore, the amount of staked external assets would be also would be equal to this amount as well, which would mean that the total staked assets is much higher than bonded assets, and as we know, that means that it makes sense for nodes to steal assets and is as we say, unsafe. In this paragraph, THORChain mentions that it's really quite unlikely to ever reach unsafe or inefficient situations. They're very unlikely to happen, and most of the time the network will be in the overbonded situation, especially if it becomes easier to run a node. Is bond rewards and penalties. So these are rewards and penalties which are made to nodes. You could also think of them as node rewards and penalties. When a node joins the network, the current block number, also known as the block height, is recorded. And when they leave the system calculates the number of blocks they were active for. So in terms of concretely how this is, this paragraph here really talks about how that is. Actually, sorry, I think it's also this paragraph. So here we're talking about how the bond rewards and penalties are actually tracked and calculated. So every block, the system sets aside bond rewards. So every time a block is added to the blockchain, the system will set aside bond rewards. And every block, it also creates one block unit for every active node. So every block which gets added to the blockchain, one block unit is added for every active node. And when a node leaves, it cashes in its block units for a portion of the bond rewards. Then those spent block units are destroyed. So take, for example, there's 1,000 room in bond rewards outstanding. Node A has been active for 30 blocks and has 30 block units, and there are 1,000 block units in total. Node A then leaves the network and cashes in its 30 block units, so it receives 30 rune, leaving 970 rune in bond rewards. Then its 30 block units are destroyed, leaving the remaining 970 block units. So this is how the system keeps track of which nodes are owed what. This last paragraph of the section here talks about penalization. And so obviously nodes are penalized for bad behavior. This is important for maintaining the structure of the system. And to keep track of penalties, the system simply deletes block units. If assets are stolen from a secondary vault, all nodes taking care of that vault are actually penalized, not just the ones who steal. For example, say a secondary vault has 3 nodes taking care of it. It needs at least 2 nodes to approve a transaction to send assets out. To prevent these nodes from stealing, if they're caught, all 3 must lose 50% of the value of the stolen assets. So to illustrate why this works, take a secondary vault which contains $2 worth of assets. 2 out of the 3 nodes who have taken care of that vault work together to steal all of those assets. The system finds out that they stole the assets and all 3 nodes are punished. Each of them are charged 50% of the total amount of stolen assets each, which is $1 each, or 50% of the initial $2. Obviously, there are 3 nodes, and $1 is taken from each of them, so a total of $3 is recovered. That means that the full $2, which was stolen, is recovered, plus an extra $1. And the extra $1 is given to liquidity providers of that pool. And in this way, nodes are discouraged from stealing assets. Next is liquidity rewards. So we've just talked about bond rewards for nodes, and now we're talking about liquidity rewards for liquidity providers. So liquidity providers receive rewards for providing liquidity, and these are called liquidity rewards. The system calculates liquidity rewards each block, and it adds all the liquidity fees up for that block. Then it divides them up according to the liquidity pool they were earned in. If there aren't any fees, the system pays out based on the amount of value in a pool. In this situation, if you're a liquidity provider in a very deep pool, then basically you'll receive more rewards. Deep here meaning a pool with a high asset value. Next piece to talk about is gas and mining fees. So assets are sent out of THORChain for various reasons. For example, when swappers swap assets, when liquidity providers remove assets from the pool, etc., etc. The network helps pay for these outgoing transactions, very nice of it. The payment comes from the external asset pool for each chain. So the Bitcoin pool pays for Bitcoin fees, the Ethereum pool pays for, or rather the Ether pool pays for Ethereum fees, etc. The network sees, so how this works is the network sees an outgoing transaction complete and records how much it costs in the gas of the external asset. This cost is then taken from the external asset pool, and over time this is paid back into these pools from system income. Next thing to talk about is the network fee for THORChain. The system charges a network fee on all transactions, and it's a fixed amount. The network fee itself is calculated by taking a bunch of recent gas prices, getting an average, and then multiplying them by some number which I'm not sure of. This makes it possible for THORChain to achieve these 3 things. The first being to be able to avoid dust attacks. The second being able to store up income for rewards after the initial emission schedule finishes, which we'll talk about in a second. And thirdly, giving the user a stable fee rather than a dynamic one which changes with the external network's fees, which is not a great experience. The network fee is collected in Room, it's worth noting, and is sent to the protocol reserve. So if the transaction involves an asset which is not Room, you pay the network fee in the external asset. Then the equivalent is taken from that pool's Room supply and added to the protocol reserve. If the transaction is in Room, then the amount is directly taken in Room. Moving on to the emission schedule. The system rewards early behavior by giving out Room from the protocol reserve, and it gives out a SIC of the protocol reserve every year. The system aims to reach 2% annual inflation after 10 years, which you can see here in this chart. And that assumes that blocks are created every 5 seconds and roughly 6.3 million are created every year. There's a tasty formula to look at there. We'll be going into more detail as we roll out more on the network on Rebase. To talk about liquidity pools. So swapping assets is managed by continuous liquidity pools, which you've heard mentioned a few times now. As far as I'm aware, continuous liquidity pools, I need to clarify this, but I think the continuous liquidity pools originated on Bancor and have been adopted by THORChain. I need to clarify that. But anyway, so during swaps, continuous liquidity pools make it possible to have totally predictable output of assets and liquidity fees, which is probably quite obviously very desirable. We've got a couple of formulae to talk about, and again, as with all of the other formulas we've talked about so far, we'll cover them in more detail on Rebases as the project goes on. But liquidity fees are collected as system income and split between nodes and liquidity providers based on the incentive pendulum. That's stuff we've covered before. Liquidity fees are paid in Room, and if a liquidity fee is collected in an external asset, then that asset is kept in the pool, and an equivalent in Room is added to the liquidity rewards. Sometimes liquidity fees might be higher than the amount of liquidity rewards owed to liquidity providers. And in this case, liquidity rewards are subtracted from liquidity fees to get the liquidity deficit. And the liquidity deficit is ultimately paid to nodes. So you can see here that the liquidity fees here is actually higher than the amount which is owed to liquidity providers. So that looks like, I don't know, maybe 55% there. And ultimately what's going to get paid out is only 33%. So if you subtract that difference, you get what is called the liquidity deficit. And this liquidity deficit is paid to nodes in order to make up for that difference. So as block rewards fall over time, the liquidity deficit should grow, because this is going to get smaller, and so the liquidity deficit is going to grow. You can basically think of it as a long-term fee that liquidity providers pay to nodes for keeping their assets safe. The conclusion here: THORChain makes it possible to swap digital assets predictably and securely through decentralized economic incentives. It does this only using information in its own blockchain, information from connected blockchains, and incentives from giving out its own native asset, Room. THORChain has very few assumptions or easy points to attack. As long as the network has more bonded capital than pooled native capital, it is safe. The system uses an incentive pendulum to keep the ratio of bonded capital and pooled native capital safe and efficient. That is roughly 50% Rune bonded and roughly 50% pooled. Thank you very much. Learn more about THORChain on Rebase. You can go to rebase.foundation, that's the website. You can also check out the other networks which we've spotlighted. And generally, if you're a part of if you support a network which could do with a spotlight like this, then please reach out to us. Cheers. Thanks very much.